So welcome back to the Millionaire Incorporated Forex Basics trading course. We're moving on to module 3 now on trading styles. So what we're going to cover is how to identify which style is best suited for us, the different styles, and creating an actual trading plan. So when should we enter a trade? This is where using all the above knowledge I outlined and you're going to put it all together. So you also need to know though what kind of trader you want to be. So this means, do you want to be a scalper, an intraday trader, a day trader, or a swing trader? You're probably thinking to yourself, what the hell does all this mean? And all these terms just outline what kind of time frame you want to be trading on and your own personal approach to trading and your personality. So each time frame comes with its own sets of issues and ability to stomach certain moves and stresses, and it all plays a part of it. So you want to ask yourself certain questions, like, are you able to sit in front of a screen for hours a day? Are you only able to handle the slow moves in the direction of your trade? How much patience do you have? And do you want to see profit straight away, or are you able to hold onto a trade for a few days or weeks to see your profit targets hit? This all plays a part of what kind of trading style suits you. So let's take a look at what kind of trading styles there are. So scalpers are usually traders that have a very short time frame for trading and also tend to have a much shorter profit targets. So these trades tend to take minutes to execute and can be a profitable strategy, but it does cause a lot of stress as price moves very, very quickly, which means you can either make your money very quickly or you're going to lose your money very quickly. So we're not going to be looking at this kind of style just yet, so we're going to skip this. It also means that you're going to spend a lot more time in front of the charts because you need to see the small changes in price movements over time to see potential setups coming, and you have to act quickly. So probably a lot more kind of at market orders being set there. Next we have intraday or day traders. So day and intraday traders have slightly longer time frames to their trades, as they usually take a couple hours to a day to complete. So the moves these pairs make are slightly larger, but they do take a bit longer to kind of set up and come full course. So this type of trading requires a bit more patience, but can make for some decent moves in price and pip movements. So the time frames you're typically using for this is, you're looking at the daily charts, 4 hourly, 1 hourly, and you're sometimes dropping down to a 30-minute chart to find a much cleaner entry for your trades. So the trades in this style of trading, you're kind of looking from day to day, and you might have sit in front of the laptop or computer for half an hour or an hour, look at certain areas and zones and certain trends, and find areas which price might come up to or come to before taking a trade. From here we move to swing trading. Now most, if not all, experienced traders advise that this is the best style of trading to do. It does take longer for trades to set up, and trades can last days to weeks to actually come to completion and hit your profit targets. But with these trades, it allows for larger movements in price of a pair, which means that false moves like in the opposite direction won't really affect you as much. So these trades usually use higher time frames such as weekly, daily, and use 4 hourly for entries. And sometimes you're going to drop down to like a 2 or a 1 hour entry just to find a cleaner entry. So with this one, you're typically looking at, like, let's say this on the weekend, spending maybe a couple of hours in front of the charts, looking for marking up your charts or whatever, and then waiting for price during the week or during the days or whatever, however long it takes to get the areas before you actually enter the trade. So whichever trading style you adopt though, what you want to do is start with the highest time frames to determine the overall direction the pair is moving, and then move down the time frames to the lower times to look for entries. So this is also, if you remember, what is called multiple time frame analysis, and this makes up part of your trading plan and strategy. So you've got to be able to kind of develop patience in looking at charts, because sometimes charts might be a mid-move away from your zone, or you might have to wait for it to come down to your zone. And when it's actually coming towards zones, that's where it really tests your patience and psychology, because sometimes it won't reach your zone straight away. And it can kind of hover above or just miss and things like that. So it does kind of test your patience a little bit there. So once you've identified what your trading style is, you'll need to create yourself a trading plan. So this is essentially a set of rules that you're going to follow before you allow yourself to enter a trade. So you have to be very disciplined with following this, as it will help you become a successful trader over the long term. So it uses the law of averages to help you accumulate wealth. So if you have a large number of wins over losses over time, overall you will increase your capital, which will allow you to increase your position size and also earn more money from trading. So here's an example of what certain rules for a trading plan. So you firstly identify what kind of trader you want to be. So I highly advise being a day trader or swing trader, and then you got to kind of identify what time frames you're going to need to look at. So if you're a swing trader, as we said, you're going to be looking at weekly, daily, and 4-hourly time frames. So the weekly chart is for the overall trend. The daily chart is to try and find areas of potential interest, and then the 4-hourly chart is looking for areas of entries. So as we said, so you're going to identify areas of interest on the lowest time frame that you're looking, and then you're going to use your risk management to actually, before you enter the trade, and then you're going to look for other confirmations. So this is where chart analysis comes into play. So you want to have multiple confirmations. So you want to be looking for the overall trend, rejections of support or resistance lines or trend lines, retracements to the 50 or 61.8 Fibonacci retracement area, chart patterns and things like that. So that will be part of your confirmation of before you enter a trade. Risk management will pretty much be determining how much capital you'll be risking per trade. So we're going to actually touch on that in a later part, because it is actually a very important part of trading. You only want to enter trades once all these criteria have been met, and this will give you a high probability of being correct and high probability of wins over the longer term. So that's it for this part. Stick around for the next part on the course.